Hey there, future investors. So, you've finally decided to make your money work for you, huh? Well, good on you. But hold up. Before you start throwing your hard-earned cash into just about anything, let's talk about asset classes. I know. It sounds all financial and boring. But trust me, it's super important stuff. Every investment out there belongs to a specific asset class. By understanding which asset class different financial products belong to, you can make your investment journey way less confusing. We're talking about stocks, bonds, real estate. These all fall into specific asset classes. When you invest, it's crucial to know where your money is going, right? Classification of asset classes has certainly made finance more manageable for the investor to comprehend. All right, so what exactly is an asset class? It's basically a group of similar investments that tend to behave similarly in the market. Each asset class has its own level of risk and potential return, and these can be affected by all sorts of stuff like the economy, politics, and society. Now, there are about 6 types of asset classes you should know about. We're talking cash and cash equivalents, stocks or equity, bonds, fixed income, real estate, commodities, and then there's the mysterious alternatives. Heard of them? Alternatives are like the rebels of the investment world. Think artwork, stamps, and other cool collectibles that can also be invested in. Oh, and some folks even throw cryptocurrencies into this category. Cash. Cash is king. Nothing offers more transactional freedom than cash. Cash includes idle money such as the funds in your bank account, savings account, in your pocket, hidden under your pillow, or in your kitchen jar. In general, cash provides the freedom to instantly purchase anything as it is considered liquid. This asset class is considered to have the lowest risk. Apart from the slow and steady devaluation of cash due to inflation, you won't lose your money instantly unless your local currency or your entire monetary system collapses. It has happened and can happen. This asset class is considered to have the lowest risk. Now let's move on to the second asset class, equities. The equity asset class is undeniably fascinating and has been steadily gaining popularity over the years. Despite being the most volatile asset class, when managed properly, it has the potential to yield the highest returns. When a company is publicly traded or listed on the stock exchange, you can invest money in those companies directly through a broker and acquire ownership in a specific company. Investing in equity implies buying into a business. When you purchase shares of a firm, you essentially own a percentage of that business. There are 2 ways to earn via investing in equities: through capital appreciation and through the dividend that the company shares with its shareholders. Among equity investments, the Equity-Linked Savings Scheme, ELSS, stands out as the only tax-saving option under Section 80C and wealth-building scheme with the shortest lock-in term of 3 years. However, equity investments, including ELSS, perform best when you invest for the long run, as they have historically delivered returns of 16%, 18%, and have outpaced inflation. Historically, this asset class has provided the best and highest returns. At the same time, it has also wiped away the investments of many when rare, black swan events occurred, such as the 2008 financial crisis and the 2020 COVID-19 issues. Next up is fixed income. Fixed income, as the name suggests, refers to a type of investment that pays the investor a fixed interest or dividend payment until a certain maturity date. Among Indians, fixed income asset class is the most popular and one of the most trusted and oldest forms of investment. Examples include fixed deposits, public provident funds, PPF, government and corporate bonds. Returns on fixed income schemes may range from 7% to 8%, but they are not inflation-beating returns. Fixed income assets are considered to be lower risk investments. Historically, fixed income assets have performed steadily during times when other asset classes crashed, but also remained steady during times when other asset classes skyrocketed. Let's move on to commodities. Commodities can be goods, properties, or products traded for various purposes. Examples include precious metals like gold and silver, raw materials like oil and gas, and food products like wheat, sugar, coffee, and corn. Each commodity has its own market dynamics and is sensitive to economic cycles and supply and demand. Precious metals like gold and silver can serve as an alternative asset class for investors. For example, 10 grams of 24-karat gold traded at rupees 540 in 1975, and the price in 2024 was nearly rupees 75,000. Commodities are for trading and hedging, not for long-term investments, except for precious metals due to their seasonal impacts. Next, the most known and common ones where great-grandparents did the investing. Yes, it's real estate. Real estate is a well-established and widely popular form of investment that encompasses properties such as plots, apartments, commercial buildings, industrial areas, and villas. In recent years, there has been a notable increase in interest in real estate investments. Additionally, real estate also includes tradable assets known as REITs, which stands for Real Estate Investment Trusts. REITs are investment firms that own and manage a portfolio of real estate properties along with the underlying mortgages. These firms allow anyone to buy shares in a publicly traded REIT. Real estate is known to have a relatively high likelihood of appreciating in value over time and can provide a steady income stream if the properties are rented out. However, it's important to note that considerable initial investment is typically required to purchase physical real estate as a private investor. That's it. These are the major asset classes we discussed in this episode. In summary, we've explored different asset classes, starting with cash, which is a low-risk asset that gradually loses value over time due to inflation. Then equity, the asset class with the potential for the highest returns, but also with volatility and risk, so it's important to have a long-time horizon when investing. Next was fixed income, a lower-risk investment with limited upside gains due to fixed returns. Real estate can appreciate in value and provide regular income streams through rental income, but can be capital-intensive to get started with. Finally, we looked at commodities, where precious metals like gold and silver hold their value over time, while traditional commodities such as raw materials or food products may not. If only there could be a way how we could combine all of the assets and make use of all of their advantages whilst balancing off their disadvantages. Oh wait, there is a way. It's called the diversification of asset classes. Please watch the video on diversification popping in the right corner to understand better. So, if you've ever wondered what the deal is with asset classes and why they matter, now you know. Stay tuned for more awesome investing tips and tricks. See you soon. If you like the video, please hit the like and subscribe to our channel and newsletter for valuable insights. Leave a comment with your thoughts and queries. Thanks for watching. See you in the next video. Happy investing.